you could just be patient for if you can just be patient for 1 minute, we'll get started right away. Okay, I think everyone's in the webinar now. So I'm Dave Yeske. Most of you know that, maybe all of you know that. And I just want to say two things. I want to say three things. Well, probably four, but you all know me. Right now, I'm at my dad's house in the country, and it's very noisy here. And I'm at the tail end of kind of a nasty cold, so I have coughing fits at times. But most of all, because Yusuf knows this stuff every bit as much as I do, if not more, this is going to be the Yusuf show, except that I'm going to give myself permission to lean in for color commentary wherever I feel so moved. So without further ado, Yusuf Abujaderi, please take it away.
Thank you, Dave, and happy Halloween to those who celebrate. To those who don't, happy Tuesday. We've got a good presentation set up for you today, and we might as well dive in. We'll show our agenda here in just a moment, but first, before we show what we have lined up, we want to take a temperature check here, just see how you're all doing. Lauren, if we could go through the first poll, thank you. How are you all feeling today? And we'd love to just get a sense. And you'll note that throughout today's presentation, we'll be having a bit of seasonal fun with the polls and some of the slides. Obviously, you can see the slideshow in itself has a theme that's appropriate for the day.
And Yusuf, if I can interrupt while we're waiting for some of these responses coming in, I like Ready for a Treat and Deja Vu. If you have questions at any point, please feel free to type them into the chat or the question and answer function. You should be able to chat on there. You should be able to ask Q&A. And this webinar is being recorded, so you can get access to it at a later time. We'll post it on our website, share it with anyone who might be interested.
Absolutely. Looks like we've got most of the responses in. Quarter of you feeling spooked, another quarter of you feeling neutral. Most of you are feeling ready for a treat. Love the attitude. Couple of you feeling optimistic, and one or two of you with deja vu, which is new for me. Thank you all for participating. How are we going to spend today? We're going to look at how markets and the economy have been performing year to date through the end of September. So the first 3 quarters of this year, we've got data galore for that period of time. We'll zoom out just a bit and look at the same kinds of information, but for a longer period. We want to look at the last 12 months. Why? Conveniently, from a data standpoint, that's not to make light of what folks have actually experienced, but conveniently, markets bottomed out on September 30th of 2022. So looking at a 12-month time frame from September to September of this year gives us a sense of some trends that can be observed, what's been happening in markets and the economy. And then last but not least, we'll zoom out even further and we'll look at how things have been going since the beginning of 2022. So 12/31/2021 or the beginning of 2022, again, through the end of the 3rd quarter of this year. And why are we picking that date? Because at the beginning of 2022, markets were at an all-time high. And so we want to see what's been happening since things peaked and we've been living through the last 21, 22 months or so. We'll also be discussing the relevant storylines for each of those periods, and then we'll end today with a bit of a discussion on our outlook through the end of the year. Of course, we're already getting buzz about next year being an election year, and so we'll look at how that kind of stuff might be affecting what you'll see in your portfolios, what we see in markets, the economy, and so on. So, diving into the first period of time, we'll be exploring year to date. Things you've heard about if you've been watching or reading the news. Higher for longer. Federal Reserve Chairman Jerome Powell said that interest rates are going to remain higher for longer. Just maybe a few weeks ago, a couple months ago, markets have been in a bit of a tizzy since. Folks perhaps were expecting that rates were going to come down sooner than the Feds had planned. And so markets may be reacting to that revisement of expectations, in addition to some other factors that we'll be discussing here throughout the presentation. Artificial intelligence, AI. I would ask who's sick of talking about it, but that doesn't matter because we're going to be talking about AI for some time. It's here to stay. But what we'll be focusing on in today's discussion is how much of the AI buzz is real in terms of how it's affecting markets and the economy, and how much of it is hype. Moving along, bond yields reaching highs we've not seen in over a decade. We'll talk about how bonds work. Yields are not the same as prices. So we'll kind of be bifurcating yields and prices, talking about how changes in yields and changes in prices affect performance in your portfolio. We have a set of slides to cover that piece. It wouldn't be a webinar in the 2020s without talking about inflation. We've been talking about inflation again for what feels like forever. Some more commentary there, although not as much as we've had in past discussions. We would be remiss if we did not at least make mention of the current conflict in the Middle East. Presently, it does not appear that markets have been overly affected. And aside from that, the humanitarian issue, the loss of life, is heartbreaking. And so we just wanted to make sure that we gave a bit of attention to that. And note that there are concerns about the conflict spreading and what that may have in store for markets and the economy. But to this point, it looks like everything is remaining localized to that region. And we're just sad to see things unfolding in the way that they are, and hope for peace as soon as possible. The final storyline that we have here on this slide is what may be thought of as surprisingly strong U.S. economic data. Again, if you've been reading the news, watching the news, you may have heard musings about us approaching a recession, quite possibly being in a recession that no one can see, a ghost-like recession, to make a Halloween type joke. We're simply not. We have not been in one. We are not in one based on the economic data that is available. And so the term soft landing, can the Fed cool the economy down, tame inflation, achieve a soft landing, which would mean, again, taming the inflation monster without creating a recession? Can that be done? So far, so good. And so with that as a segue, we'll go right into our next slide and just share some statistics about how the economy has been performing. For your consideration, in September, the U.S. economy added 336,000 jobs. Unemployment, which aside from inflation is the other half of the Fed's dual mandate, unemployment remains below 4%, which is the Fed's target. So we are at full employment. American consumers continue to spend that money. It's incredible. As you all know, there was a bit of a savings glut throughout COVID. Stimulus checks certainly helped with that. Even in spite of inflation running rampant for the past couple of years, you know what, I should revise that. In spite of inflation running a bit hot and then subsequently coming down quite rapidly over the past couple of years, the headlines have talked about inflation running rampant, but that actually hasn't been present in the data. Consumers have continued to spend. And that is fascinating and a bit befuddling to economists, and yet the numbers are what the numbers are. You might see headlines about household saving rates decreasing. Bear in mind, savings rates do not include deposits into money market funds. So many of you, our clients, and so many of Americans around the country have been taking money out of savings or taking money that's landing in their checking account and buying up money market funds because the expected return is so much higher than it's been in recent years, over the past 10 plus years. And so it may look like, if you're isolating one variable, that the savings rate is down, and it's simply not the case. Folks are just being smarter about the way that they're saving money, capitalizing on the available interest that they can earn in a money market fund. Third quarter GDP, gross domestic product, the measure of economic output, the forecast for the third quarter, which just ended a few weeks ago, 4.9% annualized growth. That's good, not recessionary. And in fact, just to poke a bit of fun at some of the predictions that have yet to come true, and in this case, haven't come true, Morgan Stanley had to revise their growth projections up after the strong retail data and spending data that we've just talked about a few bullets ago. Bloomberg predicted 1 year ago that we would have a recession. The percentage of likelihood they ascribed to a recession was 100%. They're 100% wrong as of last month. And again, that's not to poke fun from a pejorative place. It's just to note that sometimes when we make predictions, we're wrong. And that's why we at Yesky Buoy do not make predictions. Let's talk about how things played out in financial markets. Year to date, first 3 quarters of the year. Of the investments in our clients' stock portfolio, and there are 10, they are all listed here. 1, global real estate, performed poorly, down about 6.5% through the first 9 months of the year. The rest of the portfolio up nicely. You can see the scale here all the way out to 14%. The S&P 500, which again captures 500 of the largest US-based companies and their stocks performance, up 13%. But note what all the other positions in the top 5 are: international, 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 and emerging markets also capturing activity abroad. International companies have dominated performance outside of what we've been seeing from the S&P, and we have a lot more to say about the S&P in just a couple of slides here. But everything's positive aside from real estate. Also note value tilting towards the top of the page. Value stocks have outperformed their more expensive counterparts. We love when that's the case because, of course, our portfolio is tilted in favor of value stocks. They have a heavier presence in our portfolio relative to what you'll see in the global market. And we expect value stocks to perform better in times like these. And by times like these, we mean when interest rates are rising. And so it's good that we're seeing theory play out in reality as was expected. So a slide here actually charting how that theory, the value premium, which is something that is persistent and pervasive that we can observe across country lines, across time periods. Value stocks tend to outperform their more expensive counterparts most of the time. And again, specifically in times when interest rates are rising, international small value beating international small by 4%. So this is not saying that international small value is up 4%. It's saying it is outperforming its more expensive counterparts by 4% through the first 9 months of the year. The same being true for U.S. small value, a marginal spread above more expensive U.S. small company stocks. International large value taking the cake here with a 5% premium. You got 5% more in terms of return by being invested in international large value stocks, again, relative to their more expensive counterparts. The one spot where we didn't see the premium pop up was in U.S. large value. So that's when we look at the S&P 500 and compare it against the large value fund that we use for our clients. It appears that the value fund underperformed the S&P 500 by about 11%. 11% is a number to keep in your mind until we go to the next slide. So here we'll introduce an index that isn't really real, but has been getting attention if you read the financial news. The S&P 493, what exactly is the S&P 493? Well, it's the S&P 500 less 7 companies, 7 specific companies, massive tech companies. You know their names: Amazon, Apple, Alphabet or Google, Netflix, NVIDIA, hang on, I have to look at my notes here, Microsoft, and who could forget Tesla? And I shouldn't have included Netflix, sorry, I meant to say Meta or Facebook, the artist formerly known as. If you extract those 7 companies, which skew the performance of the S&P 500 quite drastically, and you look at the performance of the S&P 93, you'll note the difference in performance between the full index, which is again up 13% year to date, and the index less those 7 companies, the spread is 11%. So back to the previous slide. My keyboard would cooperate. Here we are. Minus 11 in terms of the value premium, but really, if you pull out those 7 tech stocks, the S&P 500 and US large value companies have been performing neck and neck through the first 9 months of this year. Just interesting to contextualize returns. Now, why are we picking on those 7 tech stocks? Many of them have had their performance affected by the artificial intelligence buzz. NVIDIA, we can certainly pick out as one. But a number of the other ones have specific initiatives devoted to furthering the use of artificial intelligence in various ways. It is interesting to note, by the way, that there was an executive order issued by President Biden, I believe today or yesterday, starting to regulate the use of artificial intelligence. Now, we all know that executive orders don't have much in the way of teeth. And however, it's momentum, starting the process or continuing the process of perhaps limiting the kinds of activity we can see in that particular space in the economy. So it'll be interesting to see how things unfold going forward. But what we know is when you see spreads like this, and when you see valuations for companies increasing as rapidly as we've seen, I mean, the valuations, so how expensive the stocks are for those 7, the magnificent 7, those massive tech stocks, their valuations have been increasing by 50% just year to date. So the expected, go ahead,
Sorry,
Dave, please.
No, I was just going to say, it's important to note that these price returns have not been in line with growth of earnings. It just means their valuations have skyrocketed. So whereas, you know, the long run average that you would pay for $1 of earnings in the S&P 500 is like 14 times. So a company would have a price on average that would be 14 times its earnings. Just to take NVIDIA as an example, because it's one of the ones that's really been caught up in this AI frenzy, it's trading at, I believe, over 300 times earnings. So the price hasn't gone up in line with earnings growth. It's just gone up in line with investor enthusiasm.
And so, as we know, reversion to the mean, things coming back to their long-term averages, is a statistical phenomenon that is also persistent and pervasive across any slice of time you can imagine. We'll have more to say as to why we don't just load the portfolio up on tech stocks down the line in today's presentation. What we want to do right now is take a break from talking about stocks, talk a bit about bonds, because our clients' portfolios include both. And bonds have been getting a lot of press too. So one of the questions that we've been getting a lot lately, why don't you just buy US Treasuries in my portfolio? Why are you buying these bond funds from DFA? What's the point? Talk about US Treasuries here in a second. Here's the value that comes from a fund manager. Bond fund managers are able to digest the information in the bond market and say to themselves, how can we best position the investments, the holdings in this fund, to now take advantage of whatever the changing circumstances are? And as the case has been over the past couple of years, the changing circumstances have been interest rates going up and up and up and up and up. So when rates go up, that means yields on bonds go up. Yields go up, and so prices go down to account for the fact that the yield has gone up. What do we mean by that? If I buy a bond at a price of $95, the expected yield there is $5 or 5%, meaning I buy it for $95, and at the end of the term, I get $100 back. If yields go up to, hypothetically, 10%, that means the price of the bond just went down to $90, so that I buy it for $90, and then I get back 10% or $10 and $100 at the end of the term. So with respect to the bonds that are within these bond funds, when interest rates go up, that pushes yields up, that pushes price down. But the more critical thing to look at is how long are you expecting to hold that bond? Because if you hold it past the point at which the expected return exceeds the yield at the previous interest rate, you'll make money. And so fund managers are working to capitalize on the opportunities presented by rising yields over time. You may take a hit up front, but you're better positioned if you're buying more bonds at higher yields going forward. And that's exactly what these fund managers are seeking to do. So how does this work in practice, and what does it mean for your portfolio? First of all, we'll just make sure that we recognize what's going on in the Treasury market. As of the end of September, you couldn't get a better yield in the bond market than a 6-month US Treasury, 5.554%. That's better than anything else we see on this line here, right? For any other slice of time, 3 months, 9 months, a year, 2 years, long term, 5.5%, 6-month Treasury bills took it. What does that mean for your portfolio? If you have a portfolio with Yesky Buoy, you are using 1, 2, or maybe 3 of these funds. Let's focus on the weighted average maturity of the 2 most commonly used bond funds in the portfolio. Less than half a year, a quarter of a year, and the expected yield to maturity, higher than the 5.5% that you were seeing for the 6-month Treasury bill. So just validation here that what we're seeing in terms of how the funds are being managed, the fund managers are paying attention, and they are continually updating the holdings within these funds to capitalize on what we are seeing in the bond market and what we are seeing in terms of the effect of interest rates on how bonds are being priced. And when it comes down to the bottom line, what have we seen in terms of return? This is year to date, and this is year to date through last Friday. The 2 short-term funds that we use, the 5-year fund and the 1-year fund, both clocking year-to-date returns of 4%. Now you might be saying, hey, wait, that's less than the 5.5% I thought I was going to get. And we say, this is only through 10 months. Another 2 months at the same rate, you'd be right in line with those expected returns. And so bottom line here is the fund managers are doing exactly what they're supposed to do. The bonds in your portfolio are doing exactly what they're supposed to do. And they're positioned quite well, given what we can see as far as current environment. And we're gratified to be able to report good performance. So that's bonds. And we'll pause here as we transition. Lauren, do we have any questions that have come in? Fantastic. Now, here's here's Johnny. Here's inflation. Had to make a shining joke. Sorry. Shout out to Jack Nicholson. Briefly, 1 chart on inflation this round. Just 1. In blue, the consumer price index. So headline inflation, CPI, the number that's released every month by the Bureau of Labor Statistics. If you follow the blue line and you remember what last summer felt like, there's peak inflation at 9%. And note how that number has come down, hit 3% over the summer, I believe it was the July reading, and then has bumped up a bit, still hovering around 3.5%, below 4%. What's the red line? The harmonized index of consumer prices. What is that? In all of the discussion that we've had about inflation and the various measures, we've yet to quote this particular measure. But we bring it to your attention now because currently the driver in the rise of inflation is a price that people don't actually pay. One of the biggest drivers in the rise of the CPI, again, the blue line, is owner's equivalent rent, which is an imputed estimate of what homeowners would be paying if they were renting their houses out. So an alternative measure, the Harmonized Index of Consumer Prices, because there's no shortage of ways to interpret inflation information, doesn't include this imputation. And look at what the number says. Higher inflation, by the way, last summer, this measure peaked at 10, but look where it is now. Went well below 2% and is hovering here kind of in between 2 and 3%. Incredibly encouraging when we're actually measuring the parts of the inflation story that are correlated directly to how people spend their money, and seeing this kind of information, it would suggest that the measures taken by the Federal Reserve over the past couple of years, in addition to just the actual economic cycle playing out and the perhaps at least partially transitory nature of inflation and coming out of the COVID crisis, it's encouraging to be able to see the numbers be what they are. And so we wanted to show you that and then move on. Unless, Dave, there was anything you wanted to add there. I thought I saw you.
No, I was just nodding because this chart, I think, is just so clear that yes, we got a big spike in inflation, the biggest one we'd seen in decades, and it was clearly transitory.
And with that, we'll begin kind of the next phase of today's discussion. We'll zoom out a bit and we'll include performance going back 12 months. So not just the first 3 quarters of this year, but also the fourth quarter of 2022. So in addition to the storylines we've mentioned previously throughout today's discussion, let's say these things, which have also been observable over the past year. Skewness in U.S. stocks performance, meaning that U.S. stocks performance have been skewed by, we're going to pick on the Magnificent Seven again here in just a moment, versus the relative value that's still available in international stocks. And by that we mean international stocks have outperformed, here's our second bullet, outperformed U.S. stocks, and they're still cheaper. And international stocks have outperformed U.S. stocks, even though the U.S. economy has been outperforming international economies or economies around the world. And we're also going to talk about the observable persistence of the value premium through a period of rising interest rates. So it wasn't just occurring over the past 9 months. We'll look at it over the past 12 months. We'll even look at it over the past 21, 22 months. But before we get ahead of ourselves here, let's look at returns in our clients' portfolios. Here are the stocks, again, same 10 positions that we looked at earlier. Note the scale, 32% international large value over the trailing 12 months. The international large value fund in our clients' portfolios up by more than 30%. Now you might be saying, hey, well, does that mean that at the beginning of 2022 and those first 9 months, did international fall way below U.S.? Not the case. International was almost neck and neck, within a couple percentage points of U.S. stocks. This is just straight up outperformance, dominance, you could say, over the past year. International large value, international small value up by nearly 30% as well. Emerging markets also up big, international small, international large. And note, by the way, this isn't the S&P 493. This is all 500 of the S&P stocks, including the Magnificent Seven, your NVIDIAs and your Googles and whatnot. Up a nice 20%, but not 32%. And then there's U.S. small value, U.S. large value, U.S. small. Note, in just about every corner of our portfolio, value outperforming. Large value on the international side ahead of international large. The same across the other corners of the portfolio. In fact, we've got a chart for that. There's the story again. International large value outperforming its more expensive counterparts by 11% over the past year. International small value, a healthy 6% premium there. U.S. small value, in line with averages over the past 100 years, you got an extra 4% return from U.S. small value stocks relative to the more expensive stocks in the U.S. small category. Now we're going to play the exact same game we played earlier with respect to U.S. stocks. Large value premium, negative 4%, meaning more expensive stocks, growth stocks, outperformed value stocks in the U.S. large category by 4%, right? Let's contextualize. Conveniently, and again, it's fascinating when the numbers work out that way. The difference between the S&P 500 and the S&P 493, 4% over the past 12 months. So again, if you extract whatever hype is driving the performance of those 7 stocks, and as Dave said, just pushing up the valuations in ways that aren't necessarily aligning with what you might expect those companies to do in reality going forward. Well, there really hasn't been an underperformance or an overperformance in terms of how large company stocks, the value variety, have performed relative to the rest of the S&P 500. It's just interesting to note. Along that same line, we just wanted to share a response to a question we've been getting frequently throughout the past couple of years. Excuse me, I should say throughout the past year, as the NASDAQ and tech stocks have been really on a tear. Why don't you just buy tech stocks? Well, here's why. Our portfolio in green, so our portfolio of stocks, the green line here, and this is since the beginning of 2022, it's been choppy, and yet we're down 7% through September 30th. Annualized return minus 4%. The NASDAQ index, which tracks 100 tech stocks, not 500, 100, and is even more skewed by the performance of those 7 stocks that I've mentioned a couple of times throughout this discussion, down by about double, a little more than double actually. Annualized return of approaching negative 9% throughout the past couple of years. So while it's true that the NASDAQ has done quite well at the beginning part of 2023, it did a lot worse throughout 2022. And even though it's been on a tear throughout this year, it's got a lot of room to run before it actually catches up to its prior high, which, like our portfolio, was at the beginning of 2022. We don't just focus on any one part of the market. We know that value tends to outperform growth. We don't go all in on value. It pays to diversify. We know small company stocks are going to outperform large company stocks over time. We don't go all in on small because, again, it pays to diversify. You don't see that outperformance day in and day out, and so you want to mitigate risk while maximizing return, and you do that through diversification, not by chasing hype or chasing headlines or falling victim to, as Dave was saying, frenzies of various natures.
And I just, on that chart, I just have to jump in and with some historical perspective, because I lived through it, and many of you in this meeting probably lived through it with us. But back in early 2000, when we were sort of at the peak of the dot-com frenzy, a company called Cisco had, like NVIDIA, had reached a price to earnings ratio of about 300 or 320. And Burt Malkiel, a very famous economist, he wrote A Random Walk Down Wall Street. He was an economist at Princeton for decades. He wrote an op-ed piece in Barron's Magazine in March of 2000, and he was talking about the frothiness of the tech sector. And he used Cisco as an example, and he said a price to earnings ratio has an earnings growth assumption embedded in it. And he said Cisco, with a price to earnings ratio of 300, the embedded expectation is that within 10 years, its earnings would equal the gross domestic product of the United States, which he suggested was a somewhat unlikely outcome. And in fact, by the end of 2000, the price of Cisco had fallen from 90 to 9. It fell 90%, and it's never recovered its prior level. So valuation matters. And this is why we believe so strongly in being value investors. In the long run, valuation matters. the long run,
Here,
how
here.
much you pay for something, including a dollar of earnings, matters.
Here, here. You want more bang for your buck. You want to buy low or buy cheaply and sell high, or sell when the asset or the investment is worth more, is more expensive. And that's what we seek to do by being value investors, to your point, Dave. Saw that we got a question from Terry about international stocks and whether or not they can continue to outperform U.S. stocks, even if the U.S. economy continues to outperform. We'll spend some time here on the question while we have this chart as a backdrop. The answer is yes, and in fact, it's been happening. So, you know, we'll spend a moment kind of bifurcating the difference between markets and economies. Markets are forward-looking, what's the word? Machines, let's say, forward-looking instruments. Markets take the available information and look forward and project what the expected performance will be. When we're measuring the performance of an economy, it's always with backward-looking data. So we're looking at, okay, what happened over the past quarter? We make some marks. What happened over the past year? And we make some marks. So what we've been seeing is in recent months and years, the U.S. economy has outperformed international economies. We've also seen U.S. stocks do well. What we've seen, however, is even though international economies have yet to outperform the U.S. economy, and that may happen in the coming years, it's anyone's guess, international stocks have outperformed and continue to be priced more cheaply than U.S. stocks. And so they've been a good investment, and they continue to be good investment based on forward-looking expectations, despite the fact that the U.S. economy has been performing relatively better than economies around the world. Was there another question, Lauren, that came in?
Nope, just that one. I thought it was good timing.
Yeah, and I'll just again, color commentary. The other reason to think about separating how you think about markets from how you think about economies is that markets price things for a return that is commensurate with the risk. So if other economies are not performing as well, then the stock markets will price those stocks for a higher return, reflecting the fact that those economies may be struggling. So this is the disconnect. It seems logical to say, well, a good economy should equal a good stock market, but it's actually almost always the opposite. You know, when an economy is challenged by internal or external circumstances, the markets price its capital assets, its stocks, for a higher return in reflection to reflect those challenges. So this is where it's a little counterintuitive, but really important to think about.
Yeah, but you make the point so well, Dave. Risk and return are related. And so where there's perceived additional risk, expected return goes up. We'll beat this horse just a bit deader, if I can use some poor English. Sorry, Lauren. Value premium since the beginning of 2022. I mean, I would say it's off the charts, but we've got a scale that's appropriate for the information that we're showing here. International large value outperforming more expensive stocks by nearly 18%. International small value also in the double digits. The premium here for being invested in value stocks over this period since interest rates started rising, right? I believe the first interest rate hike was February or March of 2022. Since then, look at what value stocks have been doing, beating everything else as expected. U.S. small value, double-digit premium there, and U.S. large, that's including the Magnificent Seven. That's the whole S&P 500 up there. U.S. large value ahead by 2% over the past 20-plus months. So a quick review of just the why behind what we do with our portfolios, with specific attention to the stocks. You've heard us talk about our worldview over the years. We believe that markets and economies are resilient and biased towards growth because people are resilient and biased towards growth. And markets and economies really just reflect the aggregate behavior of people around the world. We maintain global neutrality because we don't believe any one country's performance can be expected to be better than another's. There's no way to guess how performance is going to play out in the future. And so we maintain an equal weight as much as possible across countries on a pro rata basis in our portfolio. With that said, we do seek to capitalize on, and you've heard us use this word, or these words before rather, persistent, pervasive premiums, premiums that you can observe time and again throughout the course of history. Again, risk and return are related. Smaller stocks are generally riskier than larger stocks, higher expected return. The same being true for companies that are tagged as value. So we go heavier on those because, again, the expected return is higher. We mitigate the risk by diversifying, and that's why you don't just see value stocks in these building blocks that are upon which our portfolio is founded. We buy the indexes too. We get everything. There's some growth stocks in your portfolio. There are certainly large company stocks in the portfolio. And we just tilt the portfolio in favor of stocks that seek to capitalize on these premiums. And we add some exposure to real estate. It diversifies. Generally, when the market is zigging, real estate is zagging. So it buoys the portfolio in times when the rest of the market may be struggling. And emerging markets, of course, we exclude China. We made that change to our portfolio last year. But emerging markets around the world continue to be an important part of the global market. And therefore, in maintaining that global neutrality, as we mentioned earlier, they're an important part of our portfolio as well. And how has that approach performed? You may have heard the phrase, markets climb a wall of worry, whether it's any of the storylines that we've mentioned today about which there are real reasons for consternation. We're not going to make light of the troubles that people are experiencing in the world. But there's always been something to worry about. And markets have always been climbing a wall of worry.
And I love the fact that you titled it this way, Yusuf, because this is a market aphorism that has been around for more than a century, because this is another persistent factor, is that there's always bad stuff going on and markets are always digesting the bad stuff and pricing securities for a positive return.
And to your point, or to say it kind of in a different way, maybe some of the only times when it feels like a good idea to get into the stock market is when things are peaking. Whereas generally there's something to be worried about, and therefore there's perceived risk, which means expected return probably being pushed up by that perceived risk or real risk. Our portfolio, indicated by the darker green area on this chart, the benchmark, the all country world index or a global index of stocks, represented by the tan area. Of course, there are bonds included in both segments. You're seeing the performance of every open and closed account under our management over the past 30 years through the end of September of this year. Net of fees, average annual return 7%, benchmark trailing by almost a full 3 percentage points. And note, by the way, the risk measure, call it almost half, 13% relative to the benchmark, sporting a 22% measure of risk. If you were to kind of break these areas down, it would be a split of 2-to-1 stocks to bonds. So if you're invested a bit more aggressively, if you have 80% in stocks in your portfolio, the average annual return here would be closer to 8 over this period. The same is true in the inverse. But again, just looking at, without any filters, the performance of every open and closed account in our company's history over the past 30 years, you can see how the approach that we've taken and the way that we manage and rebalance accounts has played out, regardless of the story of the day or week or month or year or decade or what have you. So with all that being said, let's look forward a bit. All eyes continue to be on the Fed. They're getting together this week. Most economists at this point are not expecting another rate hike, but who knows? Who knows? If there's a hike, odds are it will be quite modest, maybe another quarter point, but we'll know again in a day or two. Again, likely that will be the last hike of this schedule, or this scheduled hikes that we've been seeing over the past couple of years. And that's because, again, the economy is still representing a state of full employment, and inflation is on its way to exactly where the Fed wants it to be. So no further tightening may be necessary. And additionally, next year is an election year. I'm sure we'll have more to say about that in our webinar to start the year in January. And throughout the year, the election news cycle is going to dominate pretty much everything else we would imagine. And of course, we'll have full coverage on that throughout the year as we get closer and closer to election day. Furthermore, we'll continue to watch the things that we always watch. How's the economy doing? What's the Fed doing? How are US markets performing? How are international markets performing? And how are the respective economies in the US and around the world performing? And what does that mean for how things are going to play out going forward? And then, of course, you know, we've talked about some of the storylines that have been dominating the news in the various slices of time that we looked at today. There will be more news. There will be more surprises. Things will develop either as expected or unexpectedly. And we'll continue to monitor how those things play into how the portfolio is continuing to perform. So with all that being said, it was a pleasure spending today with you. Lauren, I think in my exuberance throughout the presentation, I skipped one of our poll questions, which was, how do you think the economy is doing? We've spoiled that one. Maybe as we give folks a chance to send in a couple more questions, do we want to do our final poll and just ask how people are feeling now that we've gone through what we plan to discuss today? We'd love to hear from you.
If you have, are you singing
Go
in your
ahead,
head?
Lauren. No, I'm feeling gored like I should. Noah
assuming
learned
that was
this
an
year that a
intentional
pumpkin
pun.
is a gourd. Exactly. Noah learned that a pumpkin is a gourd, and so here seeing that. That's great.
And it made me think, I had to Google it to get the song, but there's a song called Sunday Best.
Uh-huh.
One of the lines is feeling good like I should. So I was singing in my head. But I was just going to comment, if you have any questions, please feel free. We've got one here in the Q&A, Yusuf, that I'll throw out once we share this poll. But feel free, questions in the Q&A or in the chat, either one, and we can get to those. All right, we've got about 75% so far response, 80. Ready
We've
for
had
trick-or-treating. I want some candy. I don't know about you.
Yeah, exactly. Complete disappearance of anyone responding with the notion of being spooked. Good. We appreciate those of you who answered honestly and indicated you're feeling neutral. Fantastic. Neutral is not bad. Optimistic, ready for trick-or-treating. Me too. I have to leave the office a bit early today so I can get into my gear and walk our kids around a couple neighborhoods.
Wait, are you dressing up to go with the kids?
I am. I may end up being some version of Severus Snape if you're into Harry Potter, which really just means I'll be wearing black and moping around. I'll see if I can find a wig somewhere in the house.
You better have a cape.
Yeah, I've got a cardigan that can serve as a cape. Yes, very dramatic. So we'll see how that plays out.
I did see one other here on the poll results, so feel free to type into the chat if you want to share what how you describe your feeling. Yusuf, the one question we do have that's come in so far is it was back on the slide, comparing the YESKI buoy returns to the benchmark. I'm just asking out of curiosity, how might that compare if we had a 30-year chart of the S&P? And then my personal addition there might be, why wouldn't that be a good comparison, or why don't we compare to the S&P 500? Because I know we talk about this a lot. The S&P 500 is in the news, in the headlines all the time.
Yeah, and so again, when we get this question, we like to highlight a few things. Number one, you own the S&P 500 in your portfolio. You are capturing that growth as part of your diversified portfolio. Number two, we pick on the S&P a lot because the S&P has dominated headlines for a large chunk of the time period since the end of the financial crisis in 2009. Large stocks in the US, for a variety of reasons, have outperformed in many of the years, not all the years, but in many of the years since the end of that particular crisis that we all experienced. Over a 30-year period, I'd have to run the numbers. Thank you for the invitation to look at yet another chart of performance. But the S&P isn't an appropriate benchmark for us to use because, again, it only captures the performance of large company stocks, whereas in the US, whereas the fundamental building blocks of our portfolio, if we can go back to this chart for a moment, we think of kind of the four corners. So US large, US small, international large, international small. So diversification across countries, across regions, and across sizes within those regions. And then within each of those corners, diversification again. We get the broad market index in US large, that's the S&P 500, but then we have a fund specifically focused on value stocks. So the S&P doesn't serve as an appropriate benchmark because it's only capturing this part of the global market, whereas our portfolio has all of this. And so we'll maybe put out a piece kind of detailing a bit more in terms of a response to that question as a follow-up for today. And we'll look at how US and international stocks have performed over the past 30, 50 years. And we'll just have some more commentary on that maybe as a follow-up, unless there's anything you'd like to add there, Dave.
Well, the only thing I'll add is that for the last 30 years, the period we're talking about, the annualized return of the S&P 500 has been less than 10%. It's been 9 point something percent. And that's 100% stocks. Our portfolios are typically a third bonds. And so if you make an adjustment for that, I think that what we actually have is probably something not dissimilar, but with a lot less risk.
Yep.
So on that,
saving me from a rabbit hole that I was probably going to fall into. Go ahead, Lauren.
On that point exactly, Dave, the question, we just had a follow-up question. Put differently, how risky would it be to be invested only in the S&P 500?
And that's an ascertainable number. I mean, we can pull the standard deviation of the S&P here and get that out as a follow-up too. We know what the standard deviation of our portfolio is, and so we'd be able to figure that out.
I can give you an example of that a lot of people have forgotten about because we all tend to be unduly influenced by the recent past. But for those of you who were paying attention and maybe even invested at that time, when we arrived at the beginning of 2010, the headlines everywhere were talking about the lost decade. And the reason they were talking about the lost decade is that at the beginning of 2010, the S&P 500 was at exactly the same level it had been at the beginning of 2000. So you'd had an entire decade in which the index had not gone up. Now, that was not true of the Esquibui portfolio because we were globally diversified and our portfolios actually had gone up during that decade. So yeah, the S&P 500 looks very attractive in the last few years with the FANG stocks, now the Magnificent Seven, having occasionally provided some outperformance. But that's how dangerous it could have been or how risky it could have been. There was an entire decade between the beginning of 2000 and the beginning of 2010 when the index was basically flat.
Yeah, and we have those numbers in terms of how our portfolio outperformed. We did a post maybe a year or two ago, a walk down memory lane or something to that effect. We can recirculate that and just illustrate kind of how our portfolio has performed through some of the most dramatic periods that we were able to chart throughout its history. So maybe some more there as a follow-up.
And I will, we'll post it when we post the recording of this webinar, but I also just posted the link to that article, Yusuf.
Awesome.
To walk down memory
Quick
lane.
work, Lauren.
That's what happens when you're a quick Google stalker or website stalker. And I just wanted to add one more comment there, Yusuf and Dave, to that piece you were just talking about, S&P 500. Tom had a great comment to us just saying it's somewhat natural for people to tilt towards US stocks, if only because of the historic patriotic sensibility most of us feel. And there is a name for that. It's called home country bias, and it is really common in investing and in behavioral finance that people often exhibit that bias in their own investments. And as Yusuf mentioned before, something we don't exhibit because we don't think that any one country can be predicted to perform better at any certain time. They all move around.
Yeah, and that thought process is driven by the data. I mean, if you look back historically, past 20 years, past 50 years, there's so much randomness in the relative outperformance from country to country throughout the years. It just speaks to the notion that it makes much more sense to diversify and not exhibit any bias towards one country, regardless of where you live or regardless of where you call home.
And Tom is observing this can change with travel. I guess the more you travel the world, the more inclined you are to think that you should be investing all around the world. And I agree with that.
Here, here.
So I'm just going to, Lauren, unless there are more questions that we need to address, miraculously, it looks like we might wrap this up in 1 hour, which for us is unusual.
Don't speak too soon. We're not done yet.
Well, I just want to say thank you, Yusuf. This was a fantastic presentation. I love how you covered everything so clearly and concisely. And I think there was a good story to be told there. And I hope everyone appreciated it. Thank you, Lauren, for your usual amazing real-time logistics.
Yes.
And thank you for all of you coming here and spending an hour with us. As Lauren mentioned at the outset, this is going to be recorded. You can go back and look at it again if you like, but certainly feel free to share the link with friends and colleagues, anyone you think might be interested. And as always, drop us a line, give us a call. If you have any follow-up questions, we always love to talk about this stuff.
Yes. Thank you all for being here. And with that, we'll close up. Take care.